From 2003 to 2007, Florida saw the largest real estate boom in its history.
Real estate sold at astonishing prices as people were sold a bill of goods known as the American Dream.
But for many, that American dream turned out to be the American nightmare.
From subprime mortgage lending and predatory practices by mortgage brokers, lenders, and improper securitization of mortgages, this era of economic boom led to the largest crash in the history of the real estate market. A crash from which Florida has yet to recover, and to which we have not yet seen the end.
The full extent of the damage inflicted by these practices has not yet been felt, but millions of homeowners nationwide have suffered from financial crisis, foreclosure, and bankruptcy. And what is worse yet, is that the systemic fraud and illegal conduct of the banks has continued to pervasively infect court systems throughout the nation. And further, the Florida court system has suffered from extreme abuse at the hands of the banks that have hijacked it and effectively turned it into a private collection agency for the banking industry. Mortgage securitization is perhaps one of the least understood areas of the real estate industry, and for good reason.
With phrases such as mortgage bundling, securitized trusts, and tax-exempt structures known as real estate mortgage investment conduits or REMICs, there are many terms employed to describe massive collections of bundled mortgages which were broken up and sold off in pieces.
While this method of bundling mortgages was once looked at as perhaps the best thing to ever happen to the mortgage industry, allowing large-scale investors such as pensions and retirement funds to own interests in mortgages in a way that was deemed safe, the securitization process has become a nightmare for the American homeowner fighting foreclosure. In fact, the securitization process has made it impossible in many, if not all cases where a mortgage is held in a securitized trust, to determine who actually owns a mortgage and a note, a fact which until recently has done little to slow down the foreclosure rocket docket.
However, there is a great deal which should be understood about securitized trusts which can aid in the foreclosure defense and provide the judiciary with further insight, especially when it comes to the constitutional and judicial requirement of standing, which derives from case and controversy requirements in Article 3 of the U.S. Constitution.
Here let's review the creation of subprime mortgage lending and securitized trusts, the nature of standing in foreclosure actions, the process of securitization of mortgages, and the problems the foregoing have created for foreclosing lenders, who lack the proper documentation and chain of title to properly foreclose. We'll call this section Setting the Stage. A brief history of subprime mortgage lending and the beginning of the securitization crisis.
Subprime lending is a fancy financial term for high-interest loans, given to people who would otherwise be considered too risky for a conventional loan. These risky loans included enticingly low rates, often for the first few years of the loan with an adjustable rate. After that initial honeymoon period, the short-sightedness borrowers often were lured with these attractive rates, only to be shocked by exploding adjustable rates that they couldn't possibly afford on their low salaries, and especially couldn't afford once many homeowners in lower and middle-class families became unemployed. We'll call this section the bait and switch, the rise of subprime lending.
Although the subprime mortgage lending practices developed gradually over time, the start of the industry was paved by three major events.
In the 1980s, several key pieces of legislation were passed by Congress.
These various acts created deregulation of the mortgage industry in an effort to encourage homeownership by the American public.
In 1982, the restrictions on mortgage lending were further decreased in what McCoy notes was the worst of the federal laws passed during the 1980. The Alternative Mortgage Transaction Parity Act, or AMPTA, was passed, making adjustable rate mortgages, or ARMs, and balloon payments legal for the first time. Finally, the Tax Reform Act, or the TRA of 1986, encouraged more homeownership by making the deduction more prevalent, increasing the demand for mortgage debt.
Taking it further, the Job Growth Tax Relief and Reconciliation Act of 2003 cut the tax rate on capital gains to 15%, adding fuel to the fire by encouraging speculative investment in real estate due to the disparity in tax rates on regular income versus capital gains from real estate investment. And, Significant changes within the mortgage industry itself were creating a system ripe for making high-risk loans because the potential payoff to the bank justified the high rate of default for such loans.
First, interest rates began climbing, making it more difficult for people to get traditional mortgage loans.
Second, mortgages were bundled and sold as mortgage-backed securities, or MBSs. As securitization took off on Wall Street, for the first time, lenders could make loans and then sell them off in packages, maximizing their gains, while allocating various levels of risk to investors.
At a lightning-fast rate, mortgage loans went from being illiquid to liquid assets, and for the first time mortgage brokers began making a premium for selling or disposing of the loans upon origination, instead of only the upfront fee they charged to borrowers.
There are several players within the subprime mortgage industry that contributed to the current crisis. In Confessions of a Subprime Lender, former industry insider Richard Bittner documents what he called the mortgage industry food chain, which sets forth the position and importance of various players who are involved in creating, packaging, and selling subprime mortgages as mortgage-backed securities. The base of the food chain, like all good food chains, begins with the small animals that are building blocks for the larger predatory animals. In this food chain, the small animals include borrowers, mortgage brokers, and small-time lenders. The larger animals include big lenders and investors, government agencies such as Fannie Mae and Freddie Mac, investment banks, rating agencies and financial institutions.
And of course Congress, at the very top of this chain, gouges itself on the largesse from these institutions that lavish significant campaign contributions on individual congressional members. It is all of these players working together that created the gunslinging process of subprime lending and, as a byproduct, mortgage-backed securities.
Traditional mortgage loans before the subprime mortgage lending crisis were created and serviced by the same lender. Thus, the lender had a vested interest in making sure that the borrower to whom it was making a loan could support the monthly payments and would not default on the loan obligations. These lenders are called portfolio lenders and are now a dying breed. However, after subprime lending took over, portfolio lending became the exception rather than the rule, and the mortgage lending industry and lenders lost incentives to keep loans in-house and on track. As Professor Adam Levin, an associate professor of law at Georgetown University and an expert on mortgage securitization, explains, it is of course the very nature of securitization that made it so appealing to mortgage lenders. As larger financial institutions figured out how to securitize mortgages to allocate the risk to different investors by selling securities based on different levels of risk, called tranches, they began purchasing subprime loans from small mortgage lenders. Mortgage brokers, the street hustlers of the lending world, would find borrowers and get paid a premium for creating subprime loans, seducing millions of people into signing on the dotted line. Then, instead of holding on to the loans as traditional lending practices had called for before, subprime lenders sold the loans, and the very high risk of default that goes with them, to investors who are looking to buy these types of loans, investors such as pension funds and 401k plans. As noted by John Atlas and Peter Dreyer in their article The Conservative Origins of the Subprime Mortgage Crisis.
Perhaps the most confusing issue when dealing with securitized trusts and what those trusts mean with regards to foreclosure standing is understanding what securitization is. While there are many explanations, some lengthy while others brief, understanding the process of securitization and the repercussions from a defensive perspective can truly allow for a crucial offensive strategy. Further, it is essential for any lawyer or judge involved in the foreclosures to understand the process of securitization, the key components, deadlines, contractual obligations of a trustee and a servicer, and how the failure of certain procedures or parties can lead to a nightmare for a foreclosing trust, and potential salvation for homeowners trying to get out of a financial nightmare.
A simple definition of securitization is a process where thousands of mortgage loans are bundled together into financial products called mortgage-backed securities. However, this is an oversimplified definition that does not give true credit to the structural complexities of MBSs. The complex definition of the securitization process requires an explanation of the key steps, and how they interact with one another. And that is the topic of our next video titled,
Deconstructing the Black Magic of Securitized Trusts. How the mortgage-backed securitization process is hurting the banking industry's ability to foreclose and proving the best defense for a foreclosure defense Part 2.
Please stay tuned. Only with a thorough understanding of how the process was supposed to work can we learn what was done wrong in each of our own home loans. And learning what was done wrong is our best defense to beating these banking giants at their own game.